Welcome back to Investing Talk Podcast.
Today, we are counting down the top 5 stocks to buy right now, based on our latest research.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show.
Yeah, definitely helps us out.
And if there's a specific company you want us to look into, leave it in the comments below.
All right, let's start the countdown. What's the first company on our list?
First up is Circle Internet Group. The reason it's standing out is its dominant position in the crucial layer of digital asset infrastructure.
Right, that infrastructure piece is key.
And we are seeing revenue growth that is incredibly strong. We're talking 53% year over year in the latest Q2 2025 report, which, shows massive operational scale.
Wow, 53%. And what's really compelling about Circle is the foundation they've built around the US dollar stablecoin network. They operate the leading compliant network, which currently has, $62.3 billion in circulation?
Yeah, $62.3 billion. That gives them an enormous network effect, meaning the more people use it, the harder it is for any competitor to catch up.
Exactly. That network size builds what we call a compliance moat. They've spent the capital and time navigating complex U.S. financial regulations, establishing secure protocols.
It really acts like a massive competitive wall against smaller, less regulated crypto entrants.
Absolutely. And when you look at their flagship digital currency, it has had 0 DPEGs, meaning it hasn't lost its dollar value even during periods of intense market stress. That resilience is what institutions require.
That's huge. And we have an imminent catalyst that could turn this from a strong story into a, spectacular one. The Q3 2025 earnings report scheduled for November 12, 2025.
Right on the corner.
Yeah. If they show continued operational scale and successful navigation of regulatory shifts, that news could provide significant upside.
Technically, the market seems to be holding its breath a bit. Our analysis of momentum shows the 14-day Relative Strength Index, or RSI.
That's basically a gauge of how quickly a stock has moved up or down.
Yeah, exactly. It's sitting in a neutral zone around 1.9. So it's not overbought, meaning there's plenty of room for that expected rebound post-earnings announcement.
Okay, so Circle is an infrastructure play leveraged to a huge macro trend of digitizing finance, but one that has done the necessary groundwork on the compliance front. Now, shifting gears dramatically from digital assets to mobile marketing, what's the next pick?
Interesting. Moving on, my pick for the next one is Digital Turbine. This one is less about dominance in a new field and much more about the turnaround story in a pressured industry.
Okay, a turnaround play. Tell me more.
Well, despite recent macroeconomic pressures that hit the mobile advertising sector hard, Digital Turbine remains the dominant mobile growth platform specifically for carriers and original equipment manufacturers, or OEMs.
That integration gives them a unique operational moat, doesn't it? Very difficult to dismantle.
It does. And we have tangible proof that the turnaround is working, straight from their latest Q2 earnings. Adjusted earnings per share, that's the standard measure of profit, after factoring in specific adjustments, hit $2.15.
Is it $1.15, and what was the estimate?
It substantially beat the $5 consensus estimate. Even more impressively, their adjusted EBITDA jumped 78%.
78%, wow. For listeners who might not track those metrics daily, EBITDA earnings before interest, taxes, depreciation, and amortization is often used as a proxy for operational cash flow.
Right.
So a 78% jump confirms that their core cost management and strategic repositioning are incredibly effective.
It's a massive confirmation, especially since the market was highly skeptical. We saw the stock actually drop 6% after reporting that massive earnings beat.
Really? After that kind of beat?
Yeah, that tells you the market is still questioning the sustainability of future growth.
But if we connect this to the bigger picture, their strategy seems sound. They are leaning heavily into AI, right?
Oh.
Expanding their data platform offerings.
Exactly. With the DTIQ AI platform, which drove 45% sequential growth in their core technology. They're making their product stickier, more essential.
Okay, but we have to address the core risk. Why can't an OEM or a major carrier just, build this technology in-house and cut Digital Turbine out?
That is the crucial counterpoint. Definitely a risk to watch. But the moat isn't just the software. It's the highly integrated relationships and the established switching costs.
Oh, the relationships.
These major partnerships with carriers and OEMs are deeply embedded in how phones are set up and how data is monetized. For a carrier to rip that out and build their own, they face huge logistical hurdles, and the risk of losing optimized advertising revenue.
Makes sense.
And if Digital Turbine continues executing on the AI front, they make that hurdle even higher, setting themselves up to capture significant advertising volume as the sector rebounds.
So technically, is the market starting to buy into this?
It looks like it. The stock is reflecting this growing trust. It's trading above both the 50-day and 200-day simple moving averages.
Okay, those long-term indicators. When a stock consistently trades above both, it suggests the market believes the recovery is structurally sound. The short-term noise might be subsiding.
Precisely.
Okay, let's unpack this. Next up, we are looking at Hims & Hers Health. This one feels like a pure growth story in the massive field of telehealth. The fundamentals here look almost flawless for a growth company.
They really do. Revenue growth is accelerating, hitting 49% year-over-year in Q3 2025.
Almost 50% growth. And what's even more compelling, I think, is that they've decisively turned the corner on profitability.
Yes. They reported $16 million in net income for Q3, and their adjusted operational cash flow EBITDA topped $78 million. That's huge for a company at this stage.
It really is. The real potential, though, seems to lie not just in current growth, but in their innovation engine and market expansion. They recently launched a new specialty focused on menopause and perimenopause.
That's the one analysts are buzzing about. They're looking at this specific new segment as a potentially $1 billion incremental revenue segment.
$1 billion just from that segment.
Potentially, yes. It could set them up for massive growth through 2026.
That move into women's health feels like a strategic game changer because it targets a huge, historically underserved market.
Totally agree. And it's not just about sustained revenue growth. It's about margin improvement, too. If we look at their trailing 12 months, or TPM net income, it stands at over $133 million.
Okay.
More critically, their projected EBITDA margin is expected to nearly triple this year compared to last year, from just under 6% to over 13%. That rapid scale-up in margin is the hallmark of a successful direct-to-consumer platform.
Right, scaling efficiently. But let's hit the risk profile. This stock is volatile, isn't it? It has a high beta, currently sitting around 2.4.
It does. And beta measures a stock's sensitivity to overall market movements. 2.4 means if the market moves 1%, this stock tends to move 2.4%.
So that attracts growth capital, yes, but for many investors, that is a flashing warning sign for risk management, especially if that projected $1 billion segment doesn't materialize quickly.
That's absolutely a fair point for risk-averse investors. High growth often comes with high volatility, no doubt.
True.
But the market is rewarding their execution, as evidenced by the stock being up, 150% year-to-date and consistently trading above its moving averages.
Okay, 150% is quite a run.
The combination of financial rigor, demonstrated profitability, and market diversification, like that huge potential segment, gives Hims & Hers a very strong overall bullish rating. They are moving from a single product growth story to a diversified healthcare platform.
Interesting. Okay, what's number 4?
My fourth pick is strategy. Now, this is not a traditional operational pick. This is the top pick for investors seeking maximal leverage exposure to the digital asset market, specifically Bitcoin.
Okay, so a Bitcoin play, essentially.
Very much so, but with a twist. This stock has been hit hard by the recent sector volatility, but the market consensus remains a resounding strong buy. The average 12-month price target implies over 87% upside from current levels.
87% upside potential. That's huge. And you mentioned it's been hit hard. What do the technicals say?
Well, we see that opportunity reflected clearly in the technicals. Because the stock has been down 32% over the last 3 months, its 14-day relative strength index is deep in oversold territory, reading at 27.70.
Okay, 27.70 on the RSI. For listeners, when we say oversold territory, we mean the momentum gauge. The RSI suggests the stock has been sold off too fast and too far relative to its history.
Exactly. This signals a high probability bounce setup for what we call mean reversion traders investors, betting that the price will snap back toward its average. It's essentially a technical discount entry point.
So that extreme low technical reading makes the stock fundamentally a proxy for leveraged exposure to Bitcoin. If you believe the institutional acceptance and price of Bitcoin are set to rise, strategy is often seen as a way to get a turbocharged return without holding the asset directly.
Correct. And what is fascinating here is the dual revenue model. While the massive Bitcoin treasury gets all the headlines, their enterprise AI analytics platform provides a necessary, stable underpinning and a separate, growing revenue stream.
Right. They still have that core software business.
And the institutional interest remains strong because they are beating sales expectations for that software business, reinforcing the narrative of operational excellence alongside their aggressive digital asset strategy.
So the stock is currently trading like a pure Bitcoin proxy, maybe like a miner, but it has a robust traditional software company underneath.
That's a good way to put it. Their price targets, clustering near $500, reflect massive conviction, not just in a recovery in the digital asset market, but also in the continued expansion of their AI analytics tools.
Okay, interesting blend there. So rounding out the list, what's our final pick?
Finally, rounding out our top 5, we have Novo Nordisk. This is the structural growth pick.
The pharma giant.
Exactly. This company is a global leader in the booming GLP-1 space, which covers blockbuster drugs for diabetes and obesity care. They have what we call a fortress-like balance sheet, meaning very little debt and huge cash reserves, and an attractive valuation.
An attractive valuation for Novo Nordisk. That's surprising, given the hype around GLP-1s.
It is. For a company with such high growth prospects, an attractive price-to-earnings, or PE, ratio is rare. Their PE of 13.22 suggests the stock is significantly undervalued relative to its growth potential, especially when compared to peers.
13.22 PE. Okay. And they're facing more competition now, right? And those compounded drug threats?
They are. The company is fighting back hard against emerging competitors and compounded drug threats, using aggressive pricing strategies and extensive litigation to defend its market share.
But the biggest structural win they just secured was expanded FDA approval for Wegovy to include the MASH indication, wasn't it?
That MASH indication is absolutely huge, and we need to understand the scale. MASH, or metabolic dysfunction-associated steatohepatitis, is a serious type of liver disease linked to obesity and diabetes.
And there weren't many treatments before.
Almost none that were effective. By securing this expanded approval, Novo Nordisk has not only diversified its drug use beyond traditional weight loss, but has tapped into a vast, new, and relatively unaddressed market segment. This vastly expands their total addressable patient population.
They are essentially setting the terms of engagement in the GLP-1 wars. That FDA approval wasn't just a regulatory hurdle overcome, it immediately secured massive future revenue streams.
Pretty much. It is interesting to note that the stock experienced a sharp temporary correction after a guidance cut a few months ago, falling over 21%.
Right, I remember that dip.
Analysts now maintain a buy rating with a 65% upside from current levels, making that recent correction look like a phenomenal entry point.
So the pullback was maybe an overreaction?
It looks that way. Their operational performance is strong, and with Q3 2025 earnings beating expectations, the narrative is shifting back to sustained structural growth driven by the sheer size of the obesity and MASH markets. The fundamentals, like 25% revenue growth, are simply incongruous with the recent price dip, making the valuation look very attractive.
So what does this all mean? We've got a list that covers everything from crucial digital asset infrastructure to mobile advertising turnarounds.
And from high-growth telehealth platforms to dominant pharmaceutical leaders. It's quite a mix.
It's a list balancing aggressive growth driven by technological innovation and market expansion with the stability offered by structural dominance and favorable technical entry points following short-term volatility.
Right. In the next 3 months, with major earnings reports due for Circle Internet Group, Digital Turbine, and Novo Nordisk, will be critical validation points for the thesis behind each of these companies.
Yeah, lots to watch there. The key takeaway for you, the listener, is that this list isn't just about high growth percentages. It's about high-quality growth protected by moats, be they regulatory compliance, OEM integration, or patent dominance in a massive disease category.
Well said.
So to recap, our 5 stocks to watch are Circle Internet Group, Digital Turbine, Hims & Hers Health, Strategy, and Novo Nordisk.
Solid list. As always, do your own research before making any investment decisions. Thanks for tuning in.